down the hammer and pick up the pencil. You're about to listen to the Savvy Radio Show. Learn from real-life real estate investors, experience revealed with the Savvy Landlord as your host.
Ladies and gentlemen, boys and girls, yep. Oh, it's Investor Weekend, and man, we're sitting in the studio with a celebrity. Jeff Holz from, several markets. Grand Rapids, Michigan, Chattanooga. Where else have you lived at?
Just Chattanooga. Well, I lived in Cairo, Egypt for a little while.
Yeah, MBA, on his way to studying real estate in Harvard, wants more brain damage. Anyway, so if you don't know Jeff Holz, saying it right, make sure you clarify, because you're an attorney. Deep inside, you like to correct people.
I do.
I'm just playing. Anyway, if you don't know Jeff, who we're about to get into something very powerful, and I normally don't do this. I picked him up at the airport yesterday, and I was like, bro, the knowledge that you're dropping, we need to do a podcast tomorrow. And he's like, I'm down. I said, okay. So if you want to know more about Jeffrey, you can go to episode number 535. Other than that, Jeff, what were we talking about yesterday? Market cycles?
Yeah, that's right. Market cycles.
So what makes you so giddy about them, and how'd you jump in them? And are you into historical data, or do you use that to buy more property? Tell me some details about market cycle and where a lot of people go wrong with them.
Well, I mean, so what jumped me in on them was just that I have a lot of real estate, so I wanted to make sure that I wasn't going to lose my shirt, right? So I wanted to learn a little bit more about the cycle. So I just started doing some research, and then I came across an article by this guy, Fred Fulvery. He wrote it back in like 1997, 98, something like that, called The Depression of 2008, where he predicted the market cycle would peak, the real estate market cycle would peak in 2006, and then the business cycle would peak in 2008, and he hit those numbers right on. So I was real interested in what he had to say, and he actually wrote an entire book about it. So we just kept...
Interesting. You know, when people talk about market cycles or historical data, in my mind, I'm thinking they're passionate about stocks of some sort. Have you ever dabbled in stocks before, or where's this fascination in this arena? Is this just because it's based on real estate in general?
Yeah, so I mean, I have played around in stocks a little bit, but I'm actually terrible at picking stocks, so I try not to do it anymore.
Get it.
I pretty much always lose money when I pick stocks, so I just, I try to get with long-term mutual fund type stuff now and not trade at all.
Yeah, I'm not into stocks at all, but when I hear people, people try to woo me over to stocks, well, for 10, 15, 30 years, and there's a wonderful book called Real Estate Riches by Dolph DeSuze. Have you ever read that book? But basically in that book, he compares, he takes the stock market for 30 years and compares it, bar none, to the real estate market, a 100% comparison. And real estate just crushes the stock market up and down through all the cycles of those 3 years. And I think a lot of people come up with this market cycle, and they use this is why we're brainwashed to conformity, that a lot of people, financial services people that salesmen, run around and they pull out of the stock market in 10-year segments.
Oh yeah.
And I think that's where a lot of people get confused. As society is like, you and I have been not debating, but we've been chatting about, you brought what changed my world last night as we're driving around. You're like, dude, an average cycle is 18 years. And I was like, kind of like pause for a second. I was like, how's that possible when it's 10?
Right. That's
right. And I'm just trying to preface where people are getting this information from, false information. And so you went back, read this book. What else did you learn from this, or what did you gain from this market cycle? What's your perception of market cycle?
Yeah, so I mean, the most interesting thing is that it is 18 years, actually. The market cycle has been 18 years. The historical data is super clear on it. Starting back in 1800, that Fulvery went back and tracked all the market cycles since 1800, and all but 2 of the cycles were 18 years exactly. Not like 15 years, some years, and 20 others, and it averaged to 18 or whatever. It was like literally 18 years, like 1800 to 1818, 1818 to 1836. That's what the market cycle was. And that's how we used to predict the peak in 2006, actually. So that's really interesting. The exceptions were actually World War I and World War II screwed up the cycle. And that's kind of what we're coming out of. We're kind of hangover of 2000, the shorter cycles that we saw immediately following World War II. So what happened is in World War II, 2 cycles skipped. It went 48 years from peak to peak. And then we had a couple of really short cycles after that in the 70s and 80s. There was one that was 6 years and one that was 10 years. So I think that's where the 10-year myth comes from, because a lot of the people that were writing about it were like, hey, the market cycle's 10 years. And they started repeating that because that's what it was. And then we went back to 18 years.
So, okay, fascinating. You were telling me something about population or some indicators.
Yeah. So
tell me about that.
Yeah. So the thing is, you can tell kind of where you are in the market cycle if you just know a couple of key questions. One question is, are you above or below long-term historical occupancy averages? So what you do is you look at, like, if you're talking about, say, apartments in Oklahoma City, right? You would look at the average, like 40, 50-year average, not like a 5-year average, but this long-term average of what occupancy levels is. And let's just say it was 95%. I'm making that number up. But if you're at 96%, you're above. If you're at 94%, you're below. Okay. So if you know that indicator, you can that's one of a couple of indicators you need. The second indicator you need is you need to know if occupancy levels are going up or down. If you know the occupancy levels are going up and you're above the long-term average, then we know for sure we're in an expansion phase. If you know they're going down and you're above the long-term average, then you know you're in what's called hypersupply, which just means more supply is coming online than new demand.
So that would be a boom for contractors and builders of apartments.
Yeah.
But then all of a sudden there's a turn that happens and then it's like a ghost town.
Right. Well, so what happens is the peak of the market is actually the day before the recession, right? So, it's really sad. But what happens is there's an incentive, as long as occupancy is above long-term averages, to continue to start new projects. And new projects take like 1 to 3 years to build. So people are starting new projects, and then one day we hit the long-term average and the next day we're below, right? Because we're in a decelerating market at that point. And once you get below the long-term average, then rents start falling. You start seeing things like rent abatements. You start seeing higher vacancy. People are trying to chase occupancy levels. And at the same time that's happening, you have all these new projects that were started a year or 2 years ago coming online, which deepens the recession. And that's really what happened in 2009 and 10, is that you saw a lot of supply coming online. And then by the end of 2010, there was no new supply coming online, and occupancy levels finally started to creep back up. And once that happens, then you're moving into recovery, but there's still rents are still falling at that point. Occupancy levels are coming upward, but you're below the average. So maybe you're at 90% occupancy instead of 95, right? And if you think about this logically, it makes good sense. If you're an apartment owner and you have a 100-unit apartment complex in Oklahoma City, and you're projecting your numbers based on 95% occupancy, because that's the average, and you're at 97 and it goes to 96, you're still happy, right? Because you're above where you expected. But the second you hit 94, you start panicking a little bit, right? You're like, oh, I got to work on this. I'm below what I projected.
Well, I'm real conservative. I'm like 80. I'm doing great.
Right.
That's how I think. But this is...
Yeah, but if you're going to compete in the multifamily market, especially the bigger product, like 100, 200, 300 unit apartments, you've really got to project it the same way everyone else in the market does, or you can't buy them.
Sure. All right, so let's go into this occupancy rate that's a high number, but there's only so many people living. There's only so many babies being born. Is there a supply and demand situation here? Like, or people just like get divorced and move into an apartment? Like, what's the indicators on those sides? Like, because we're saying occupancy, is that because it's a Class A property? And why is there a shift like that? How does that happen? Does new apartments come and people move in droves, and then single family operators like myself?
Yeah, so each market's going to be different, right? And this market cycle stuff applies to each market class. So it could be single family homes, and you could look at the occupancy levels or the ownership levels of single family homes too, or office buildings or whatever it might be. But there's a certain amount of continuous increase in population over the long period in the United States. And so if they're building faster than population increases, that's how you get to hypersupply, right? There's more supply coming online than there are new people moving into the market or new family starts. So, kids move out of their parents' house and they go get an apartment, or they get a divorce and now there's 2 new families instead of 1. So there's all these different factors that cause growth in households. Okay. And that's really what you're looking at. So that demand's continuously growing.
And I always see when I'm looking in a market, I look at what, how many units were sold.
Yeah.
That's just a simple indicator for myself. If I see, 3 years ago, only, 15,000 units were sold, and I see 20,000 units now, something's happening in the market. What would you think that would be happening? Would that be a growth, or would that be a decline? Or that obviously it's a shift somewhere, and that's a pretty big jump.
Yeah. So, I mean, obviously, if there's a lot more sales in the market, that doesn't necessarily indicate that the market's growing or shrinking, because you can be selling the same product over and over again. So if 15,000 houses sold 2 years ago and this year 20,000 houses sold, but it was, 10,000 of them were the same as the 15 that sold before, it might not be that much of an indicator. It can just be a sort of like a frothiness in the market that can happen sometimes.
And so do you think that when you're doing market cycles, are you studying markets, do you drill all the way down to like-minded, like it's a 3-bedroom, 2-bath, and you throw out two twos? Or and then do you take an indicator, like say we're in, in Oklahoma, we're in oil, a lot of our economy is oil. We're trying not to rely on oil. And then we also have a military base, and people get a little nervous about those two things. Do you look at that when you're looking at market cycles?
Yeah, I think you have to. So each market's different, and you have to understand the local market that you're investing in to know where it is in the market cycle. And there are some services that track this stuff. So you can, for the big metropolitan areas, Chicago, San Francisco, you can actually buy the data. But if you're going to try to pick a smaller market, especially like a Chattanooga or something like that, you really have to look at all that stuff and think about what are the trends, population trends, what are the employment trends, and if there's like a military base like there is here in Oklahoma City, if that base is going to close, it's going to significantly impact the market. And you can't, it's not a national market. People think that all the time. It's like, well, we had a peak in 2006 and that's great. And if it's 18 years again, the next peak's not till 2024. I can't say that's going to be the case, but it's possible that we still have a little bit of room left in the market. And but it's different in every market, right? So it could peak in Oklahoma City tomorrow, but it might not peak in Chattanooga for 5 years. I don't know.
Yeah, I know that I've been here for a while, and I feel like we're slower in the trends. Like, East Coast, West Coast, we see it happening faster and more devastation. But here, I noticed that when I was through a cycle, I've been through 2 cycles here, and the just recent one was when the oil collapsed, okay? And then all the high-end jobs disappeared, and all those people ran out of the state. And they moved on because, their $150,000 salaries were wiped out. And then when the people that did stay were taking $60,000 a year jobs, and then they couldn't afford the big houses, it caused a huge flux. And I could just see it just as a landlord. The type of the client that I was receiving in inquiries was totally different than it was just 5 years ago.
Yeah. And honestly, that's the big reason why I'm in multiple markets, right? It's a diversification of risks. Because you just don't know. Detroit's a perfect example. I have some property in Detroit, and when the automotive crisis happened in 2008 to 2010, there was tons of jobs that just evaporated overnight. It caused a really big problem for Detroit. Now it's starting to recover now, and it's looking pretty good, but I don't know that something like that won't happen again. So then I started buying in Chattanooga and in Georgia, and maybe in Oklahoma City next. Now that we're here, we'll check it out and see what's around.
Man, I can show you the town. Anyway, so this is a great little mini podcast on market cycles. Do you have any more thoughts on it? And again, reference that book again that you read. I'm fascinated.
Yeah, so it's called The Depression of 2008. He wrote it in 1998. It was Fred Fulvery. So it's Foldvary. And I think you can Google it. It's for free online. It's a short little book kind of breaking down the market cycles. He updated it in 2007. And I think he might even have written an article since then about, he calls The Depression of 2026, I think. So that's kind of interesting. So I haven't really spent a lot of time reading the newer stuff, but I'm interested in digging into that.
Well, man, I'm digging you. All right. So people want to dig into you as well. And you have your own YouTube channel, soon to be podcast on a regular. And it's called oldfashionedrealestate.com. Is that right?
That's right, yeah.
And what do you guys do on that show?
So we just drink old fashions and we talk about real estate. This is kind of this mini format.
So it's not do we need an AAA meeting afterwards?
We don't require you to drink while you watch the episodes, but it is actually timed to be about the amount of time it takes to drink one drink. So if you sit down with a drink and you watch the show on YouTube, by the time you finish, we're done with the episode.
So I have this vision of like the Survivor parties. Hey, we're going to meet at 8:00 at Thursdays. There's a bunch of gals in front of the couches.
Right.
So we're going to do that here in Oklahoma
Yeah,
City. We're
it's
going to have an
gonna be
old-fashioned party. Hey, everybody come over to Kenny LeBlanc's house, and we're going to get the ice frozen like a ball.
Yeah, that's good, man. I mean, I'll if you start doing those regular, I promise I'll show up for at least one or two.
All right, awesome. We want you back here for sure in Oklahoma City. And I'm excited that you're going to speak, and we're going to learn so much from you. I appreciate your commitment to not only educating people and giving and without receiving, because I mean, you just continue to give out information without anything in return. And I think that's my philosophy as well. I think that's why we're kinship in that. Anyway, again, go to oldfashionedrealestate.com. Follow these guys, Brian and Jeff, and you will learn a lot from them, especially this on market cycles. And I expect you guys to finish this through on the next Old Fashioned.
Yeah, well, we've already filmed the next couple episodes, but this is definitely a topic we're going to cover in the future.
Okay, looking forward to it.
Thanks.
Investor Weekend is not far off, with over 10 information sessions to increase your portfolio. Log on to www.investorweekend.com. Whether you are a seasoned investor or never purchased a property before, you don't want to miss the Investor Weekend. Join us for a powerful, knowledge-packed weekend with over 10 informational sessions that are bound to enlarge your real estate investments. You will hear from the best national and local real estate investors that will share practical and relevant experiences with you, the investor. There will be several networking sessions to connect with other like-minded people for potential funding, partnerships, and yes, hot deals. Go to www.investorweekend.com. Did you know we meet once a month for the Landlord Lunch meeting? The third Wednesday of every month. Go to landlordlunch.com.
Thanks for listening to the Savvy Radio Show. Glide online and listen to our other motivating episodes at savvyradioshow.com. Connect on Twitter at LandlordBook and always be buying assets.